Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwagu. Coming up on the program, IMF approved $7.6 million debt relief to Burundi to cushion COVID-19 effects. Fitch Ratings affirms African Development Bank's long-term issuer default rating at AAA with a stable outlook. And biggest South Africa Bitcoin exchange raises funds for expansion. First, the markets. And markets across Africa looked bullish at intraday on hope of a coronavirus vaccine. The Nigerian stock market showed signs of rebound at intraday with a marginal gain of 0.01%. The South African JSE index was up almost 2%. In Egypt, the EGX 30 was also in the green, up almost 2% as well. Kenya closed in the red on Monday. And in the Middle East, markets were also positive at intraday with the Dubai financial market leading the gains. The index was up 1.14%. Abu Dhabi was up 0.43%. In Qatar, the index was up 0.26%, while Saudi Stock Exchange was in the green, 0.34%. All right, while the EU deal and vaccine hopes lifted markets in Europe, the UK stock market was lagging behind, but at least it managed a small gain in the morning. Let's see what the sentiment is like this intraday. Let's talk to Juliana. Hello, Juliana. Good afternoon. So what's driving market sentiment this intraday? Is it hopes for a vaccine or the latest data on UK borrowing, which has hit new records?
Good afternoon, Chimeze. As you were mentioning, Europe, that's the biggest story in Britain this morning in terms of business story. Anyway, there's been a positive reaction from that record-breaking mammoth talk. This is the first time they've come together with a recovery. And even though we're not in the EU anymore until the end of the year, what happens there still is being closely watched by traders. So we opened in positive territory at early trading, and at intraday, it's still in the black. The FTSE All Share is up 0.57%. The FTSE 100 is up by 0.54%. And the FTSE 250 is up by 0.80%. In the currencies market, the pound is up on the US dollar by 0.28%, up on the euro by 0.26%, and also up on the Japanese yen by 0.25%. You mentioned, Chimeze, the pretty gloomy detail coming from the Office of National Statistics about public borrowing in the UK, currently standing at £2 trillion, which is equivalent to the amount of GDP. Of course, the statement we're getting from the Treasury and from Downing Street is that they will borrow to get the British public back on their feet. The only issue is, of course, is that this money has to be paid back. I was speaking to Bissy about this morning, actually. There's a lot of speculation that when Chancellor Rishi Sunak gives his autumn statement in October, I believe, that there will be a further austerity move by the Conservative government, which is very familiar here in the UK. They've been doing that for the past 10 years, or rise in taxes. Already we know that the capital gains tax is being revised. There could be many more to follow.
In the meantime, the Bank of England's chief economist is saying the UK economy is in a V-shaped recovery. How soothing is this revelation for investors and, of course, policymakers?
Not really soothing at all, actually, because none of them agree, as you can imagine. If you talk about all of the national bodies like the OECD, like the Office for Budget Responsibility and the EY Item Club, many of them agree that Britain is heading into a deep, dark recession, anything between a contraction of GDP by 10% to upwards of 20%. Andy Haldane has been speaking in front of the Select Committee of MPs here in London, and he kind of clashes with what we heard last week from one of his Monetary Policy Committee members. I've got to get her name right, Silvana Tenreo. She was speaking to the LSE last week, and she said that the recovery is pretty slow here in the UK, and she worries about unemployment. Now, Andy Haldane, he has always said for the past 2 or 3 weeks, actually, that he does believe that the recovery here is a V-shape, and he did reiterate that today. But again, like I said, it's come up under much scrutiny, not just because he is publicly going against one of his fellow MPC members, but also when they did vote for stimulus back a couple of weeks ago, when quantitative easing was increased to about £750 billion, Andy Haldane was the lone MPC member that voted against this stimulus. So he's becoming pretty much a controversial character. But according to him, since it got to the worst stage here in the economy in May, British growth has grown 1%. So output has grown 1% every week since lockdown. And if you consider that's probably about 12 weeks and GDP fell by 20%, he thinks that that sharp dip is soothingly on the uprise. But like I said, there are a lot of people that disagree with him. So those statements haven't moved markets at all.
All right, in corporate news, nearly 50,000 UK-based staff at banking giant RBS Group have been told they will not go back into the office until 2021, just days after Prime Minister Boris Johnson said employers should begin encouraging people back into the workplace. What is this discussion around this?
Well, the discussion really is wait and see. On Friday, we had further announcements from Prime Minister Boris Johnson. One of them, of course, was, asking employers to use their discretion about people working from home. The government are really keen on trying to get people back into the workplace, no less because of the economy. If people aren't at work, people are not buying coffee, people are not dining out for lunch, people are not buying clothes on their way home. So the Treasury are relying on that footfall from commuters and from workers, because without them, you rely on tourists. And we know that there are no tourists here in the UK again. RBS have made this announcement. They got some other further announcements. I believe they're changing their name to the NatWest Group tomorrow, so I'm sure we'll be talking about that in the morning. But they have said that they have asked their staff to continue working from home. Of course, it's important to mention that these are only the staff members who can work from home. If you are working in the counter giving customers money, then you will be at your job. So I believe at the moment they've got about 89 branches across Scotland that are open, that do have thousands of staff working there. Many of them are working on reduced hours, but in terms of the backroom staff, the engine, they are able to stay at home, which will probably be a bit of a blow to the Prime Minister, because like I said, he's trying to encourage people out. But he did say last Friday that on August the 1st, there will be a further announcement about getting people back to the workplace. And I'm sure that this coincides with Friday's new rule here in Britain, which is that everybody who's out and about must wear a face mask. And I think that's to prepare the country for millions of people coming back on the streets.
And like you said, we'll wait and see how that plays out. Thank you. Enjoy the rest of the day. And European stocks advanced in the morning after European Union leaders reached a deal on a €750 billion recovery fund to help the region recover from the coronavirus crisis. Let's talk to Chelsea for more on this. Hello, Chelsea. Good afternoon. Well, the EU leaders have decided on a €750 billion coronavirus recovery fund after 4 days of intense talks. How are markets reacting at the moment?
Well, these were very intense negotiations. We heard stories of leaders walking out of discussions, people slamming their fists, calling each other names. So the fact that they were able to reach an agreement is really bolstering markets today. Here in Frankfurt, the DAX is up almost 2%. It's actually erased all of its losses for the year, which is pretty incredible given the fact that Germany is heading for its steepest recession since World War II. So definitely a lot of optimism among investors. This money is obviously very crucial to Eurozone economies, especially ones that have been hit really hard by the crisis like Italy and Spain. But it also really does send a message to the world that Europe is standing together, that they can come together on these really contentious issues. And that's also really helping bolster sentiment here in Europe, that if another crisis comes, if there are more economic hardships ahead, that European leaders will be able to band together.
And EU officials have said they want this money to be used to transform the bloc's economy. What exactly does that mean?
That's been a huge part of not just this 750 billion euros and the recovery fund, but also for the wider European budget that was also passed. They really want this money to be going into things like climate change efforts and digitalization. So those have really stood out as two of the areas where EU leaders want to see this money going. They've set a goal that 30% of the money that goes out to these countries will be put into climate-friendly policies. So that could be things like increasing electric vehicle charging stations throughout a country, improving rail systems, also improving renewable energies, things like that. But they also really do want to see this digitalize the EU economy. A lot of EU countries have sort of lagged behind Asia or the US in terms of digitalization. So this could also help things with like 5G strategies. So they really are seeing this as not only a short-term fix for Europe as they face these coronavirus slowdowns, but also a way to sort of set the path forward for Europe over the next several years.
And European banks could lose as much as 800 billion euros on bad loans over the next 3 years because of the coronavirus crisis. That's according to a report from consulting firm Oliver Wyman. Can Europe's banks survive such a big hit?
So European banks aren't yet at a crisis moment. They have obviously taken a hit from the coronavirus economic upheaval here in Europe, but so far we haven't seen bank failures, things like that. But you do have to consider the context here. European banks have been really weak since the financial crisis. They never recovered in the same way that American banks did. So we've seen low profitability and a lot of other problems dogging these banks for years. And some were just starting to climb out of this. Now they will be facing really substantial losses on loans. So money that they've given for mortgages, for vehicles, for consumer loans, that could all really start to become a problem for European banks. Also, a lot of businesses are really surviving on the aid that they've gotten from the government. There is obviously more money coming in help for EU economies, but at some point these employment programs, these loans for businesses, they will run out, and we could see a lot more bankruptcies throughout the European economy. So that could definitely put more pressure on these European banks. They have set aside some money already for bad loans. So in the first quarter, about 25 billion euros was set aside. That's much, much lower than the 800 billion euros that this report is saying could be a worst case scenario for European banks. So this really does raise the question of how they will get through this. The consultancy mentioned that they could possibly need support from governments. Things like mergers between banks is always on the table here in Europe as well, but it's certainly a difficult road ahead for these banks.
I thank you, Chelsea, for details on those. Enjoy the rest of the day. And in Asia, markets rose today after investor sentiment was supported by a slew of positive news on the coronavirus vaccine front and likely also from a pivotal European deal on a pandemic recovery fund. In Japan, the Nikkei 225 gained 0.73%. The Topix added 0.36%. South Korea's Kospi index rose 1.39%. Australia's benchmark ASX 200 added 2.58%. Hong Kong's Hang Seng index advanced 1.83%. China's mainland shares also rose. And stock futures pointed to opening gains after a strong performance in technology shares pushed the S&P 500 in positive territory for the year. Dow Jones Industrial Average futures implied a gain of more than 200 points at the open. S&P 500 and Nasdaq 100 futures also traded higher. The overnight action followed a strong performance in technology shares on Monday that pushed the Nasdaq up 2.5%. We'll take a break, and when we come back, we talk about iron ore on the commodities market update. Just stay with us. On commodities market, we are talking iron ore. Nigeria's Ministry of Mines and Steel Development had hinted that the resuscitation of the Ajaokuta Steel Company and the National Iron Ore Mining Company projects will gulp about $1.45 billion. Our President Muhammadu Buhari recently named the Abo Railway Complex after the former president of Nigeria, Goodluck Ebele Jonathan. When completed, the railway will serve as a major artery for the evacuation of iron ore from Itape, Nigeria's largest iron ore reserve, to Warri. Well, let's bring in one of the research analysts with financial derivatives company, Nneka Okolo, to tell us more about this. Good afternoon, Nneka. Thank you for joining us.
Good afternoon. Thanks for having me.
Now, the Abo Railway Complex, when completed, will serve as a major artery for the evacuation of iron ore from Itape. What is the importance of this development in steel production in Nigeria, especially with the imminent revival of the Ajaokuta steel mill?
Well, first of all, iron and steel are major commodities and are important commodities in any economy. In fact, they are quite relevant in industrial revolution. Now, Nigeria has till date been dependent on iron importation for its industrial revolution. Therefore, while revival of the Ajaokuta steel mill is quite relevant to iron production in Nigeria, the completion of the Itape-Warri rail line is most significant as it connects the supply front at Itape to the production front at Ajaokuta, and finally to the distribution front at Warri Port. In this light, the Akpo Railway Complex, recently named after the former President Goodluck Ebele Jonathan, the federal government's decision to do this naming, to name it after the former president, is quite resounds the relevance of the rail line project to Nigeria's industrial revolution.
Rio Tinto, the third largest steel mining group in the world, with revenues of about $40.52 billion. That was as at 2018. Now, this company is making substantial investment in Guinea with record developments that we have seen now in Nigeria's iron ore mining industry in view of the revival of the Ajaokuta steel mill. Do you think that global mining majors like Rio Tinto will see Nigeria as an attractive investment destination?
Well, indeed, currently Rio Tinto holds 45% of the Simadwa blocks 3 and 4 in Guinea, and has reported development of the country's largest iron ore deposit, even amid the coronavirus pandemic. Now, being that Nigeria is more developed than Guinea in most aspects, this should draw our attention to other factors that could make Nigeria an attractive investment destination. For example, ease of operations. While investors are keen on making returns on investments, they'd also be looking out for investments that are not so volatile. They'll have a kind of a level of risk accommodation. So ease of operation is one important factor that could attract investors' interest into what we are doing, into our focus on the mining industry. Other factors include cost of operation, which directly affects returns, government policies, how favorable they are, and also there's also currency stability. So these are the factors that we actually need to consider before thinking about investors like Rio Tinto coming to Nigeria.
Now, this year, the price of iron ore jumped by nearly 22%, supported by concerns of supply disruptions in Brazil and stronger demand in China. Now, despite its competitive deposits, Nigeria is a net importer of iron ore, with its iron and steel imports nearing about $1 billion as at 2018. Now, Will the increase in iron ore prices motivate Nigeria to become self-sufficient in the production of iron ore or a net exporter of the commodity?
Well, definitely, the higher prices will motivate any country to want to be self-sufficient in iron production in order to reduce its import bill or to become a net exporter of the product in order to gain more revenue. However, with Nigeria's current status as a net importer of iron, there are other stages that we need to get to. So we need to first of all get to self-sufficiency before we then talk about becoming a net exporter. In order to become self-sufficient, in addition to current developments in the mining industry, we also have to think about making the business profitable, both for local and foreign investors alike. And there has to be local demand for the commodity. And in general, there has to be profitability in the iron production business. When there's local demand and production is going on smoothly and the quantity produced is able to satisfy demand, then we are at the level of self-sufficiency. Now, if production grows steadily and exceeds local demand, then we can now talk about becoming a net exporter of iron.
All right, thank you very much for talking to us on that, Nneka Okolo, one of the research analysts with Financial Derivatives Company. VAL, South Africa's biggest Bitcoin exchange by trading volume, has raised 57 million rand to help fund further expansion. Proceeds from the capital raise will be used to explore new products for the South African market, including collateralized lending and derivative trading, and to broaden the company's presence on the continent. The exchange, founded in 2018, facilitates trading in more than 50 cryptocurrencies, including Bitcoin and Ether. It has raised 79 million rand to date. And the International Monetary Fund has approved $7.6 million debt relief to Burundi to help address the economic impact of the COVID-19 pandemic. It said the relief for 3 months will be potentially raised to $24.97 million over the next 21 months if resources are available. IMF has revised downwards the country's economic growth projections for 2020 by 5.3 percentage points to minus 3.2% this year. Burundi has so far had 328 cases of COVID-19 and 1 death. And Fitch Ratings has affirmed the African Development Bank's long-term issuer default rating at AAA with a stable outlook. The ratings agency states that a AAA score is due to the extraordinary support the bank receives from its shareholders, and it's forecast that the net debt will be fully covered by capital from member states by 2022. However, Fitch maintains that the bank's intrinsic rating has been revised down to AA- from its previous AA rating due to expectations that the bank's asset quality will deteriorate as a result of the COVID-19 pandemic. Fitch also notes that the independent review initiated by the Bureau of the Board of Governors of the process and report of the Ethics Committee, which exonerated the president of the bank, Akinwumi Adesina, of allegations of misconduct, will be resolved soon and will not affect the path of capital subscription by shareholders. And that's it on the program. Thank you for watching. I'm Chimeze Obi Iwago.